$100. For some people, it's just another expense. A trip to Costco, dinner with friends, a pair of sneakers on sale, a few things from Amazon. The money leaves your account, and within a few days, you barely remember spending it. That's normal, because $100 doesn't feel like it can change your life. It feels too small, too ordinary, too insignificant. But here's something most people never stop to think about. That same $100 can tell two completely different stories. In one story, it's gone by next week. In the other, it becomes the first step towards something most people only dream about: $1 million portfolio. Not because $100 is a magical number, not because someone found the perfect stock, and definitely not because they got lucky. It happened because they understood one simple idea that most people ignore for years. And by the time they finally understand it, they've already lost something they can never get back: time. Every day, our brains make hundreds of financial decisions. Most of them happen automatically. You stop for coffee before work. You order food because you're too tired to cook. You see something on Amazon and think, it's only $20. Nothing feels expensive, but that's exactly how habits are built. Not through one big purchase, but through hundreds of small ones. The strange part is, people think exactly the opposite when it comes to investing. They look at $100 and immediately think, that's not enough. I'll start when I have more money. Maybe next year. Maybe after the promotion. Maybe after paying off debt. Maybe after life becomes less expensive. But life almost never becomes less expensive. There's always another bill, another subscription, another reason to wait. And waiting is often more expensive than people realize. Because investing isn't only about money. It's about giving your money something that can't be bought later: time. So, why does time matter so much? Why can the exact same $100 produce completely different results depending on when you invest it? The answer has almost nothing to do with picking the right stock, and everything to do with how money grows. Let's find out. Time. It's the one thing every investor gets for free. Yet it's also the one thing most people waste without realizing it. Here's why. When most beginners think about investing, they ask the wrong question. Which stock should I buy? Is now the right time? What if the market crashes? Those questions matter, but not as much as this one. How long can my money stay invested? Because history has shown something surprising. The biggest advantage isn't usually picking the perfect investment. It's simply starting earlier. Think about how most people approach money. When they get a raise, they upgrade their lifestyle: a nicer apartment, a newer car, a more expensive vacation. Nothing is wrong with enjoying your money. The problem is, our lifestyle often grows faster than our investments. That's called lifestyle inflation. And millions of Americans experience it without even noticing. Every extra dollar has a job. The question is, are you giving it a future? Or just another expense? Here's something interesting. Imagine two people earning exactly the same salary. They both work hard. They both receive the same raises. One decides to invest just $100 every month. The other keeps waiting for the perfect time. 5 years later, their lives still look almost identical. 10 years later, still very similar. That's why waiting feels harmless. Because the cost isn't visible at first. The real difference doesn't show up in the beginning. It shows up much later. And by then, it's incredibly difficult to catch up. This is where most beginners get confused. They believe investing is about making money quickly. History suggests something different. Investing is usually about allowing small amounts of money to grow quietly for a very long time. It's not exciting. It rarely makes headlines. But that's exactly how many long-term investors built wealth. Not through one perfect decision, through hundreds of ordinary ones. Of course, starting early doesn't mean investing carelessly. You still need a plan. Because investing without a plan can quickly become gambling. So before you buy your first investment, there are 3 things every beginner should understand. Not complicated strategies, not secret formulas, just 3 simple principles that can completely change the way you invest. And the first one might surprise you. Before you try to grow your money, you need to make sure one unexpected emergency doesn't force you to sell everything. Before you invest your first dollar, there's something you need to understand. Investing doesn't eliminate risk. It changes which risks you face. Many beginners think the biggest risk is losing money in the stock market. But history tells a different story. One of the biggest financial risks is never investing at all. Because while your money sits in a checking account, something invisible is happening. Inflation. You don't see it. You don't get a notification. But every year, your money quietly buys a little less. The same $100 that fills a grocery cart today may buy much less in the future. That's why simply saving money isn't always enough. But here's where many beginners make a costly mistake. They hear this and immediately start looking for the best stock. The next Apple, the next Nvidia, the next company that'll make them rich. The problem? Nobody knows the future. 20 years ago, very few people imagined companies like Netflix or Tesla would become what they are today. And 20 years from now, the biggest companies may look completely different again. That's why experienced investors often don't chase predictions. They build systems. Instead of asking, which company will win? They ask, how can I own the businesses shaping the future? That's exactly why millions of Americans choose index funds and ETFs. Instead of betting on one company, they own hundreds. If one company struggles, others may continue growing. It's a simple idea, but simple doesn't mean ineffective. In fact, history has shown that many professional investors have struggled to consistently outperform broad market index funds over long periods. So, if you're just getting started, your first goal shouldn't be beating the market. It should be staying in the market. Because the longer you stay invested, the more time your money has to work. Not every year will be positive. Some years will be disappointing. Markets rise, markets fall. That's normal. The people who build long-term wealth don't avoid every downturn. They prepare for them. And that's an important difference. By now, you know why starting matters. You know why diversification matters. But one question still remains. Can small investments really grow into something life-changing? To answer that, let's look at what history has shown over decades, and why consistency has often mattered more than starting with a large amount. By now, you've probably realized something. Building wealth isn't about making one perfect investment. It's about making good decisions. Again, and again, and again. That's where one simple habit changes everything. Consistency. Let's say you decide to invest $100 every month. Some months, the market goes up. Other months, it falls. Most beginners see a falling market and think, maybe I should stop investing. But experienced investors often see it differently. When prices fall, the same $100 buys more shares. When prices rise, it buys fewer. Either way, they keep investing. Not because they know what the market will do next, but because they know something more important. Nobody consistently predicts the perfect time to invest. This strategy has a name: dollar cost averaging. It sounds complicated, but the idea is simple. You invest the same amount on a regular schedule, every month, every paycheck, without letting emotions decide for you. Over time, this removes one of the biggest enemies of investing: fear. Because the biggest mistakes usually happen when emotions take control. People buy after prices have already gone up, then panic and sell after prices fall. They end up doing the exact opposite of what successful investing requires. Now let's go back to that first $100. By itself, it doesn't look impressive. It won't make you rich overnight. Neither will the second or the third. In the beginning, progress feels slow. Sometimes, it feels like nothing is happening at all. But that's how almost every long-term investment journey starts. Small, quiet, almost invisible. Then something changes. Your investments begin generating returns. Those returns may begin generating their own returns. And over many years, small contributions can grow into something surprisingly large. That's the power of compounding. Not because it works quickly, but because it keeps working while you stay invested. When people hear about million-dollar portfolios, they often imagine someone who earned a huge salary or made one lucky investment. But in reality, many portfolios were built much more quietly. One paycheck at a time. One monthly investment at a time. One decision repeated for years. There was no shortcut, no secret, just discipline and patience. So here's the question. 10 years from now, when you look back at today, what will your first $100 become? Just another forgotten expense? Or the first step toward a completely different financial future? Because the biggest difference between people who build wealth and people who only talk about building wealth isn't knowledge. It's action. Your future portfolio won't be built in a single day. It will be built by hundreds of small decisions, starting with the first one. So, if this video changed the way you think about investing, consider subscribing to Wealth Magic. Every week, we break down investing, personal finance, and wealth building into simple, practical lessons anyone can understand. Thanks for watching. And remember, your first $100 isn't valuable because of what it is today. It's valuable because of what it has the potential to become.